Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 16th of April. I'm Daniel Lam, your host for the podcast. The weakening US dollar is a key positive for Chinese equities. The DXY has failed to stay above the important 100 mark, and it has broken below the 50, 100, and 200-day moving average. This helps Chinese equities, and indeed for EM equities in general, because it cheapens the cost of import of US dollar-denominated goods. With the continued improvement in global sentiment, we are seeing some revival in the Hang Seng Technology Index, which is one of our opportunistic ideas and yardstick for measuring the performance of Chinese technology equities. Now, technically, the index has been hovering around the 4,900 initial resistance level and attempting a sustained break above. Now, global AI-related trade is obviously important for the performance of this index, and it has been expanding rapidly and increasingly a structural driver of cross-border goods flows. China is actually now the largest exporter of AI-related goods, according to the WTO. In recent years, its export strength has been increasingly driven by integrated circuits, which is a key input for AI. Now, China's AI-related trade is not just limited to integrated circuits and spans the value chain, actually, from raw materials to hardware manufacturing, AI technology development, and application deployment. But it is very important to take note that China's strength in AI trade is asymmetric. Its AI-related exports are broad and diversified across products and destinations, while its AI imports are actually very concentrated on high-end chips and advanced manufacturing equipment, highlighting the continued dependencies on frontier technologies. Now, the 15th Five-Year Plan targets research and development investment growth of more than 7% per year to address these bottlenecks. Also, the AI Plus initiative aims to accelerate AI integration into traditional industries, and this can lift productivity and competitiveness, supporting the export base over time. Now, looking ahead, China's low-cost energy supply, scalable computing infrastructure, and strong manufacturing capabilities should continue to underpin its comparative advantages in AI-related trade. But it is very important to take note of the speed at which China can move into the higher value-added segments of the supply chain. And that rests on the progress in domestic technology development. Now, it does face geopolitical frictions, including tighter technology controls, stricter energy regulations, and scrutiny on national security. We noted before that US technology companies invest far more into AI capex and commands more pricing power. We see Chinese companies to be in the value spectrum of the AI space with chances of making breakthroughs using a lower budget. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.